Welcome to the All Financial Hour podcast with Steve All.
You know, occasionally we'll mention names of big investment firms like BlackRock and Goldman Sachs. Another one is Bridgewater. Its CEO was talking recently about picking investments, and he said that they have 400 people working on this day and night, and they still get it wrong 40% of the time. Those are big numbers. So if you're trying to pick stocks in retirement, can you afford to be wrong 40% of the time? And Steve, bottom line, how can you help make this not a guessing game?
Well, I think when we start to look at it in the investment worlds, the 401ks really gotten simplified. 25 years ago, there were all kinds of options. Now it's basically brought down into large caps, mid caps, small caps, and target date funds. There's not as many options when we start to look at that. So once we get into retirement, having a fully balanced portfolio is very, very important. And that's what I like about Brad Jenkins and Market Guard. He compared and he made a simple analysis with me. He said, Steve, investing is like making cookies. One, you got to have the right ingredients. Vanilla is part of cookies. But if you don't care for vanilla, but you like vinegar and you put them in, your cookies are not going to be very good. So you have to have the right ingredients. And then you need the right allocation, the percentages of what we have in it. You can't put in 6 eggs, 4 pounds of sugar, and a half gallon of vanilla and expect for your cookies to taste right. Mm-hmm. But the biggest thing that he talked about is how long do you keep the cookies in the oven? And I look at more of that risk-reward side of it. Some people like their cookies soft and chewy. Some like it more done. It's just got to be warm. But what the clients like the most about is the added peace of mind is knowing that they're going to pull the cookies out of the oven so they don't get burnt. So if you're looking for a proprietary investment methodology that uses non-emotional, methodical, and mathematical approach to the things that most people are concerned about, questions always come in. Steve, should I hold? Should I sell? And if I did sell, should I get back into the market? Give me a call now. Ask about Market Guard so we can look how our ETF portfolios and stock portfolios could fit you in your retirement years.
You know, with the stock market hitting all-time highs, it's making many wonder if there's a major correction coming our way, right? When's the other shoe going to drop? And then there's the Fed and its interest rates. Here's wealth manager Emily Hill on CNBC.
The Fed have become very adept at signaling what they're going to do. They've said they're going to cut rates once, and I expect that they will. Inflation data, I think, by the end of the summer especially, is going to continue to surprise positively. And so I think we are actually set up for a very good situation for markets. It's going to enable one, potentially two, but most likely one rate cut in the fall. And I would say overall, the bull market as a result is going to be intact. And I think Chairman Powell has pulled off a soft landing.
All right. Well, I guess, we could all sit here and speculate, but is it too early to ring that victory bell, or is it time to start putting some protection in there?
Well, the idea around it of it is you could listen to or read, I don't care, pick one magazine and go through it, and you're going to have people like Emily that say everything's fantastic. And then you got the other people, well, wait a minute, they told us we were going to have 7. And now all of a sudden they say that we're going to have 1, and we believe them. So could it be more? Could it be less? I have a problem that I don't think the Fed's going to jump in and lower interest rates right before the presidential election. I think, just staying out of the political aspect of it. But that's the thing that we start to look at when it talks about the things that we got going on right now. Inflation. Yes, it's higher. Go to the gas pump and fill up your gas tank. Go to the grocery store and buy groceries, or sit down in a restaurant today and think about how much those things have increased. So those things, the inflation, people are feeling that. And those higher interest rates, a lot of retirees are enjoying the higher interest rates. Why? Because their CDs and their money market accounts are paying more. So they got that. If you're buying an annuity for an income purposes, you're going to be able to get more income for the same dollar. Why? Because that's what they do when they do pensions. This is a personally funded pension. You're buying it from an insurance company. So that is good for the people there. Who's it bad for? If you're borrowing money, If you're trying to buy a house, if you're trying to buy a car, those are the things that go. But when we start to look at, is it time to put money in? Is it time to take money out? I remember I got a call from a radio listener. He said, Steve, in 2007, I saw a lot of things that were going on in the market, so I pulled my money out of the market. And he said, and I was feeling really good about 2009 because people around the water cooler, and it was like their 401ks were now 201ks. They lost so much, and they looked at it. And he said, and then the market started to go up, and every time I thought about getting back in, I didn't. This phone conversation was in 2019, 10 years into a bull run, and he was still sitting on cash. Why? Because he did not know when he should get back into the market. And that's what I love about the investment philosophy with Market Guard. It's non-emotional. It puts it back in. It answers the major questions that most people have in the investment world. Should I hold? Should I sell? And if I did sell, when should I get back in? So if you did move away from the market and you're concerned about how to get back in, give me a call now. Let's talk about the Market Guard philosophy. Let's talk about their target date funds that have moved a little bit away from the market. And when the non-emotional mathematical formulas say it's time to move back in, it will do it for us versus us trying to figure out what's going on. So give me a call now. If you've moved away from the market and you're looking for that idea of when to get back in, call now. Ask about Market Guard.
The name of the game, whether you're investing in the market or you have other different tools and vehicles, retirement is all about income, income, and income. And, we've talked before about the benefits of annuities, especially the ones that guarantee income, and they offer you the form of a monthly check. But how much should you put into an annuity? Here's annuity advocate Cheryl Moore with winkintel.com.
I don't think that anyone should put 100% of their assets into an annuity because these are considered long-term savings instruments. You definitely need to have a rainy day fund or money market account or some kind of savings account where you can access your money in the event of an emergency. The answer is it really depends on the person that you're dealing with on how much they should put into the annuity. But I think it's universally true that no one should put 100% of their money into the annuity.
Okay. Well, what are your thoughts on this, Steve?
Well, my idea around it is the thing that I like to look at for that personally funded pension. I like to sit down with that client and find out, what are your guaranteed incomes that you're currently getting right now? How much are you getting from Social Security? If you have pensions or any other annuities that are currently paying you an income that's going to be guaranteed for the rest of your life. And you've got your living expenses. If there's a gap between those two, I think that's very important. Tom and Terry had come into the office and they were looking at it. They had a gap of about $2,500 in their accounts. And they asked me, Steve, how do we do this? I said, there's 3 ways that we can do it. If you're in that situation, here's the 3 ways. 1, we can take it out of your investment accounts, 4% rule. 2, I can buy a dividend or a bond portfolio and we'll just take the income off of that and it'll meet the money that you have. Or we could go to a life insurance company and find out how much it would cost to fund that $2,500 guaranteed for the rest of your life. So a lot of people look at it and say, Steve, well, those annuities, they're illiquid. Mm-hmm. And I said, if I'm setting money aside for you to take 4% out of it, that's illiquid too. And if I built you a bond or a dividend paying portfolio, that's illiquid too. So where do we go? How do I look at it? Which one would cost me the least? And with interest rates as high as they are right now, the personally funded pension could be a very good tool if you've got a gap between your living expense and your lifestyle. I believe that we should, as all possible, guarantee the lifestyle, use all the extra dollars, invest in the market, whichever we want to do. We can protect some of it. Those are the things that we're going to use for the extras in life. Let's see if we can guarantee our lifestyle. Call me now if a personally funded pension would make sense for you.
Again, that phone number for this personally funded pension, 636-230-8824. And something I want to remind our listeners about, you talk about these guaranteed income, resources here, this pension we just talked about. And, those that receive that monthly income, sort of like replacing that paycheck, statistics show they're happier, Steve.
Well, yeah, it's the idea around it. We used to call it mailbox money, but nobody gets the checks in the mail anymore. Well, you can call it ACH money or it comes into my checking account. But it's that money that we know is coming back in every month. The pension, it's guaranteed by the company. Social Security by the government. A personally funded pension, it's guaranteed by a life insurance company. And that's who's doing the guarantees for it. And we believe that that's very important because I think you said it earlier in the show. The three most important things when it comes to retirement are income, income, and income. Because if my income is being met, the ups and downs of the market, nobody likes them. But they don't affect me as much if I'm not having to pull a regular withdrawal out of that.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.